Bom dia a todos. Muito obrigado pela presença de vocês na terceira edição do Global Managers Conference, principal evento da área de Third Party Distributions do BTG Pactual. Durante nosso evento, vocês poderão conhecer um pouco mais de alguns dos maiores e melhores gestores globais selecionados pela nossa área. Lembrando que todas as apresentações são gravadas e a qualquer momento podem ser acessadas em nosso canal do YouTube. Confira lá, caso você tenha perdido algum gestor que já tenha participado nesses últimos dias. Para esse terceiro dia de conferência, trazemos um tema que atualmente tem sido muito discutido, não só no exterior, mas principalmente no Brasil, o mundo de rendimento zero. Para nos ajudar a entender um pouco melhor esse cenário, nossos convidados de hoje são Arif Hussain, Head of International Fixed Income da T. Rowe Price. Fundada em 1937, a T. Rowe Price é uma empresa americana de capital aberto que faz gestão de investimentos globais. Atualmente, a T. Rowe Price possui mais de 1,6 trilhões de dólares em ativos sob gestão. Também conosco estarão Mikael Lundström, CIO da Evli Fund Management. A Evli Fund Management Company é uma boutique de gestão nórdica com foco em investidores institucionais. A Evli Fund Management Company é 100% controlada pelo Evli Bank, fundada em 1985, e com sede em Helsinki, na Finlândia. E, finalmente, para finalizar nosso painel, Mikael Leithead, Head of Fixed Income do EFG Asset Management. A EFG Capital faz parte do grupo EFG International, um grupo privado global com sede em Zurique, que opera em cerca de 40 locais em todo o mundo. E para moderar esse painel, convidamos Vanesa del Valle, Head of Fixed Income da Allfunds. Muito obrigado, e agora passo a palavra a você, Vanesa.
Thank you, Philip. Good morning, everyone. I'm very pleased to welcome you on this third day of the Global Managers Conference for this panel session dedicated to fixed income. My name is Vanesa del Valle, and I'm a Senior Fixed Income Fund Analyst here at Allfunds. I'd love to moderate this panel in Portuguese, but unfortunately, my knowledge of the language is minimal, to say the least. So my apologies in advance, all of you listening in. Lo siento mucho, as we would say here in my native Madrid. And now I know Felipe has briefly introduced our speakers and their firms, or at least I hope he has, but I would like to ask our panelists to take a minute to just let us, give us a little bit of information about themselves before we get started. Mikael, would you like to start?
Yeah, hello. My name is Mikael Lundström. I'm CIO, Chief Investment Officer here at Evli Fund Management. I've been in the fixed income market since late 90s. Focusing on European credit and mostly sort of various sort of credit strategies, being investment grade, high yield, crossover credits. And I'm delighted to be joining this panel. Thank you.
Thank you, Mikael. Michael?
So I'm Mikael Leithead. I run the fixed income offering at EFG Asset Management, which is a asset management arm of the private bank. I've been in the market since 2003. Since 2009 with EFG, my main focus has been on global credit, both across emerging and developed markets.
Thank you. Thank you, Michael. Thank you for that. I'd also like to take this opportunity to remind everyone that you can write your questions throughout the session, and we'll be trying to address as many as we can at the end of the session. You can find that on your right-hand corner of the screen. So without further ado, I believe we can now begin our panel session on fixed income. Today marks what has definitely been an eventful first half of 2021. And with interest rates close at zero, inflation fears back in the headlines, and sustainability driving rapid change in the mutual fund industry, I believe we are all eager to hear the views of our managers during this morning's panel. I'd like to start with the subject of inflation. Mikael, let me ask you this. Do you believe recent inflation surprises will persist? And what do you believe will be the impact on Fed policy going forward?
Yes, so we think sort of that on a longer term horizon, the global dynamics that has kept inflation low, i.e. globalization and demographics, will persist. So we don't believe in a long-term sort of rise in inflation. But I think it's fair to say that we are in for a very volatile second half of this year, where every inflation number is going to be scrutinized by investors extremely carefully. So our views are that sort of inflation will gradually come down during the course of this year from where it is now, and that Fed will probably start hiking in the second half of 2022. And for ECB, we wait that will take at least 6 months longer than what it does for the Fed. But as I said, sort of we are probably in for a rather volatile period here. So I think sort of like where we think investors should position itself for this is to be in sort of have short duration, have some carry either through credits, and make sure that they're not overexposed to the potential rise in interest rates.
Thank you, Mikael. Michael, over to you. Do you believe inflation trade is far from crowded, or does it depend on the asset class?
So I think in terms of the short-term inflation outlook, it definitely got extremely crowded in the first sort of half of this year. You kind of saw it in the treasury market with the rapid rise, and if you look at inflation break-evens, they were above, the levels pre-global financial crisis. So, long-term pricing of inflation break-evens in the fixed income markets looked a bit speculative and really looked very crowded. And I think, in the last couple of weeks, you've seen a lot of maybe the hedge fund community who are much more into the momentum trade, take off some of those short-term trades. So I think that's been sort of why we've seen the stabilization, at least on the bond market side of things. I think when you look at other asset classes, clearly, in the equity markets, you saw, certain sectors, particularly in mining, and some of the other sort of reflation type sectors, big rises, big recovery trades. I think that's partly down to inflation. I think that's partly down to, I think that's partly down to the fact that global growth is forecast to take off a lot more rampantly than perhaps it was forecast at the end of last year. So I think probably in the short term, it was a bit overdone, but clearly I think the global economy is on a growth path. We're in a recovery phase. The more the vaccine gets rolled out, I think the more growth can sort of pick up. So from that perspective, maybe in the longer term, that inflation trade, the reflation trade at least is probably there's probably a bit more legs to it, but we definitely have to see a correction. I think the question is whether reflation really reflects inflation, and I would sort of concur that in the long run, certainly a lot of those long run inflation pressures don't seem to be. There's no evidence as yet whether those inflation pressures are really going to be persistent, or whether this is really about short-term supply chain issues, short-term rebounds in terms of base effects from 2020, and really just something that we ride out in 2021. By 2022, 2023, we go back to a normal pattern.
Yeah. Thank you for that, Michael. And I certainly think that there appears to be some consensus on inflation across. I'd love to turn the conversation over to yields, and specifically the zero yield environment we currently find ourselves in. Mikael, I'd love to get your take on this. Given where valuations stand today, where you find the best opportunities within the fixed income market, and at the expense of what?
Yeah, I think, as you pointed out, sort of like especially sort of being based in Europe, so obviously sort of European yields are sort of government yields are obviously clearly negative. There's some yields available in USD, but if you sort of if you hedge, but sort of like European government bond yields is for nobody an interesting trade. USD government bonds can be a little bit interesting, but not sort of hugely interesting. So I think what you want to sort of have is something that spreads are rather tight. They are sort of in the tightest quartile what they have been historically. So, and yields are very low. So the sort of risk reward of going long duration is not great. The risk reward of going overexposed to credit is not great. Where we think the best value is to have various strategies through active management to go into shorter dated crossover crossover, i.e. being low triple Bs, high double Bs, by a sort of stable type of companies who can withstand some volatility, get them in rather short dated credit. But you have a roll down, you don't overexpose to interest rates. We think that is sort of the most interesting, globally, the most interesting credit sector. And that can be in various geographies. Nordics, you can buy extremely sort of interesting strategy around that, Europe as well, and USD. Then for the more yield-seeking environment, the more sort of opportunist, sort of more risky environment, we think EM credit still has some legs to go, and that could be sort of something of interest as well. But I think sort of in all, you want to sort of make sure that you're not overexposed to duration, and make sure that you, however you choose your credit, that is a sort of a general theme across all.
Yeah, it sort of seems like what we lived through 2009 is sort of been accelerated, and we're seeing very quickly moving into the high yield and emerging market debt space, right? It seems like something what we lived before.
And I think sort of like single B spreads are now roughly both in dollars and euros are close to 10-year tights. Yeah. So overexposing credits is a bit dangerous trade. Now, our scenario is that it will probably go tighter, but sort of like on sort of all in credits is not the right trade to do. Spreads are just too tight for that. So you want to make sure that you get a sort of a carry, you have some roll down, but not sort of overexposed to those sectors. I think that sort of is the sort of that we try to do to our clients and help come up with solutions that addresses that problem.
Yeah. Thank you, Mikael. Michael, now over to you. How do you navigate credit selection and portfolio construction, given the hunt for yield in this zero yield environment?
So I think we would concur in terms of how expensive credit has got, and I think central banks have a lot to do with that in terms of pushing investors into more yieldy type products. But I think a lot of investors focus on the beta side of it, the beta element of pricing, and also of where yield is coming from. So I think there's often a focus on moving down the credit quality spectrum and not necessarily focusing on the underlying fundamentals or indeed on the value aspects. So we actually think there are opportunities to pick out higher quality credits which are still discounted relative to their averages. So if you like, there's an opportunity now in dispersion, and I think that has to come through active management rather than the sort of beta and the passive play. So for us, I think the focus really in these types of environments, when you have very tight credit spreads, is you got to think, I want to be avoiding expensive credit, expensive overpriced credit, which has maybe weaker quality to it, because central banks have essentially sucked out any kind of selection, and then focus concentrated portfolios on opportunities where there's still this dispersion to take advantage in the market. So rather than thinking about benchmarks maybe as a tool to allocate, we think the more of a sort of risk management framework. They give you the duration, they give you your target credit quality. But then within that, you really want to be as active as possible to sort of extract as much yield and as much return. And I think often investors focus on yield, but yield rarely actually reflects your outcomes in terms of return. So if you can find extra sources of return, from that credit selection to boost your yield, then that actually generates a better total return in fixed income markets. So that would be our sort of thinking and how you would navigate, particularly in this environment.
Yeah, definitely very different than last year. Thank you, Michael. I'd also like to hear your thoughts on the implications for credit investment in a post-COVID recovery.
So I think what's been interesting about the global recovery is that there's clearly countries that have lagged and countries that have led the recovery. And if you look at China, China obviously was first in, first out. And now we've got the US kind of being second in, second out. And if you think about that, that's the two world's major economies, if you like, who are sort of first out of the gates. Whereas there are a lot of countries around the world where obviously growth is lagging. The recovery is lagging either because of a lack of rollout of vaccines or because, they're not so geared into maybe the global recovery. It's more a domestic story. And therefore, I think that's creating quite a lot of unevenness in terms of that recovery. So coming out of the COVID crisis, I think the focus has to be on on looking at countries that have, strong balance sheets, strong credit profiles, also recovering, have that solid recovery behind them. Because I think actually, as we start to see policy tighten in some of the major economies, particularly in the US, then this is likely to create some disruption in terms of, economies, particularly in the emerging world. So I certainly think that's one factor in terms of thinking about the post-COVID recovery, certainly looking at countries that are going to be less susceptible to any kind of financial tightening or financial conditions tightening. The second element is really about the social dimension. And I think, pre-COVID, we were looking at, populist governments, we were looking at social change, across the world, whether it was all the way from Hong Kong right down to Chile, everywhere in the world was seeing this sort of social disruption, if you like. And I think COVID probably has only served to sort of amplify that effect, because I think there's going to be a lot of disenfranchised populace around. And I think, what we've been seeing in terms of, election results, in various countries has reflected perhaps the dissatisfaction. So I think when it comes to sort of country selection, when it comes to sort of credit selection, you're certainly going to have to think about what are those types of dimensions and how does it affect your credit selection, whether it's in emerging markets or indeed in developed markets. And certainly the final point I would make is that the other element is obviously around acceleration of disruptive trends and whether or not that has an impact on on certain sectors of the economy as well. So obviously I think we're going to talk about ESG, but clearly that type of trend, but also trends towards online. I think from a credit perspective, it's about downside risk management and potentially avoiding some of those more disrupted sectors.
Certainly seems like you definitely have to make sure you diversify across your offer sources this time around. Thank you for that, Mikael. And now I'd love to bring Arif Hussain into the conversation. And Arif, I'd love to know where you're finding opportunities in this very low yield environment. I'm not sure that I can hear Arif. All right, not a problem. Let's turn over the conversation to EMD. It's generally more of a tactical allocation, but as Mikael pointed out before, the hunter yield has driven a lot of investors into higher spreads markets, and that includes emerging market debt. So I'd love to get a little bit more of your input on this. So Mikael, if you may, it'd be great to have your views on EMD, specifically China. How has the inclusion of China across fixed income indices impacted your allocation to this country in recent years?
Sure. So I think in terms of China, I think from our perspective, what's more important than maybe benchmark inclusion is the operation and the regulatory stance. And certainly China has continued to sort of open up those channels. So I think China becomes a very interesting opportunity set. As I mentioned, it was the first country in, it's the first country out. So you have a sort of a slightly, a monetary policy, a macro policy cycle, which is perhaps less correlated with the rest of the world, partly because they're on a different timetable and partly because they have a different approach to sort of monetary and fiscal policy. So I think in terms of what we're thinking, China makes an interesting diversifier in a global portfolio because it's a higher carry market in terms of Chinese renminbi, and it's and it has this less correlated aspect to it when it comes to portfolio construction. So I think from that perspective, China is quite interesting. Clearly, when it comes to the local bond markets, you're talking about currency risk as well, so you have to factor that into your thinking. And so, I think it still may be more of a tactical allocation for many investors going forward, given that currency dimension. But I think certainly in terms of the structural flow, there's clearly going to be a lot more capital flowing into China from more benchmark orientated investors. And the market is so huge, I'm not entirely sure that's going to affect valuations. So actually for investors, it does present an interesting opportunity, I think. I would say, we're a little bit more hesitant around the investing in the credit markets. Clearly the sort of government bond, the central government bond market is pretty deep and pretty liquid. And to a certain extent, you don't require the degree of transparency on the sovereign that you might on individual credits. And clearly China is going through this process of trying to adjust and address some of its its misallocation of debt capital in the last 20 years. And so that makes I think the local bond market from a corporate perspective a little bit more tricky to navigate. The transparency isn't there. There's still a high degree of technicality around the way it trades and the way in which the ratings are done. So I think there's a lot more development on that side of things. But in terms of the government bond market, clearly there is some opportunity there.
And would that include the policy bank bonds as well?
So I think, so in terms of, when you're looking down the sort of the spectrum of SOEs and different agencies, you've got to be very mindful that there's a higher degree of, dispersion coming into the market, because essentially the market's going to be more selective, given the policy of the Chinese government to try and avoid this moral hazard risk that they've been running for the last 20 years. So I think when it comes to those, policy banks, if you're talking about, the centrally owned export-import banks or the development banks, those will all be very secure, I think, because they serve a strategic and centrally managed purpose. I think it's when you get into the sort of provincial and some of the sort of more corporate-like state-owned enterprises that you're going to start to see perhaps a little bit more divergence in terms of returns.
Do you feel more comfortable playing in the hard currency space or the local currency, maybe the hard currency credit space? And maybe sticking to what you said, right? Playing sovereigns and policy bank bonds, perhaps in the local currency market, but going into credit in the dollar market.
So I think valuations in the Chinese market right now in the hard currency space, I think, are pretty cheap for the long run. I think, clearly we've been seeing some volatility associated with, the Huarong asset management issue, which was, one of the state-owned bad debt managers, which has run into liquidity troubles. And then on top of that, you've seen the likes of Alibaba, Meituan, these types of issuers run into sort of regulatory pressures when they've butted up against, the Chinese government in terms of, antitrust legislation. And then on the property side of things, you've also got issues around, some of the largest credits in the dollar market, also sort of struggling to raise, to be solvent, if you like. But I think there's quite a pool of opportunity there on the hard currency side, and those sort of macro factors, I think, those have sort of driven the general risk premium a bit higher in China. And when you particularly look at the property market, I think, those types of property names in the high yield space, which are trading very cheap and have a very large yield pickup to them, actually are kind of attractive right now if you're a contrarian investor and you have a diversified approach and you sort of focus on some of the underlying quality factors. So I think that's where selection really comes in the Chinese space on the hard currency side. So I think there is opportunity there. You have to be able to tolerate the risk and understand some of the risks, but actually it's probably one of the more attractive markets globally. And you have an economy which is very resilient when it comes to, you know, the world, you know, the trends in the world, the global economy, if you like.
Yeah. Does the relationship with the Biden administration have any impact on your allocation to China?
So I think, you know, some people were surprised by the sort of, I guess they were expecting post-Trump for a little less confrontation. I think the interesting statement from Biden has been, you know, and he's referred to the Russians as well, is we can walk and chew gum at the same time. So I think this isn't about a complete cutoff of China from the US. I think the policy of the new administration will be very much about targeting areas where they have clear conflict, and also working on the areas where they've clearly got a shared agenda. So I think when it comes to, you know, thinking about that, I think that's what you've got to bear in mind when you're thinking about your allocations. You know, which types of companies are going to be impacted by any sort of escalation, and which types of sectors and companies, you know, are kind of resilient. And there's a lot of domestically orientated companies in China which are probably not going to be impacted by the US administration. Clearly, the one factor you have to bear in mind is the sort of compliance and regulatory list that obviously you don't want to try and avoid being impacted by any sort of sanctions policy. So again, I think you can select out those types of, you know, entities which potentially are more vulnerable to that type of risk. So the answer is yes, but only to a certain extent.
Yeah, more balls in the air, right? Thank you for that, Michael. Mikael, I'd love, let me turn to you on this, and I'd like to know your view on EMD valuations, right? And how do they compare to the credit sectors at this stage of the cycle? I know you definitely find a lot of opportunities, and specifically you said that the shorter end, right?
Yeah.
Is there a fear that it's crowded?
At times, but sort of like I don't think that's more crowded than sort of credit in general. So I think that is sort of actually more safer to be there. I think there's a sort of a, generally speaking, there's sort of a misunderstanding of how much the carry effect or sort of the roll down effect can actually enhance returns. And I think that sort of make the sort of generally the short term sort of short duration attractive across sector. In terms of EMD, it's obviously sort of a very large sort of, when you talk about credits, they're sort of across sectors or across geographies. So I think generally speaking, we see that as well as in Europe, as Europe and USD, the spreads are on the tighter side. We have seen some sort of concerns on the sort of that the COVID openness, the reopening trades that people put on a couple of months ago, that for some EMD countries you can be sort of a little bit concerned that sort of that the COVID situation isn't going away as fast as maybe people thought a couple of months ago, which means that they have a little bit underperformed, which means that we think that there you can sort of find values. So it is a broad sector. We definitely think that you should be aware.
Yeah. How much of an impact does the vaccination rate across EMD affect your allocation, and is it making you more biased towards one region than another?
We tend to look at it more sort of on a credit specific okay. Sort of specific. I mean, most of the companies are still sort of operating on a global space, right? Yeah. So what on a sort of certain country, how a certain country look like is not necessarily sort of that telling to the whole credit sort of fundamentals. If especially if your home sales is very limited to your overall sales. I think the most sort of opportunities are in cases where something underperforms because of the geography's perceived COVID effectiveness, but the companies are actually sort of more global. So when you sort of look at the sort of you see that hey, these are sort of exporters, so they don't really are affected by this. That you could see in Europe first. You could see that in the US as well. And you can see that in EMD that can be sort of actually sort of one of the best trades we think to find.
Yeah, I can gather that probably the elections going on left and right across the board definitely offering some more opportunities as well.
Yeah.
Not just COVID.
Yeah, definitely.
Yeah, absolutely. Thank you so much for that, Mikael. Thank you both for your views on EMD. It's certainly a very interesting discussion, and asset allocation within fixed income is crucial, and more so given the changing market environment. There are definitely a lot of recurring themes, but I think there's some differences across both of you that are quite interesting. I'd like to switch over to a very important subject, and one that is very rapidly evolving. That's sustainability, right? It's everyone's mind. We all appreciate how fast the industry is moving towards adopting more sustainable product ranges, and the views and the approaches definitely vary very widely. And I'm sure everyone is really eager to hear your views on the subject. So, Michael, let's start with you. I want to know, in what regions are clients demanding sustainable investments most? In which fixed income segments specifically, if you can tell me?
So I think Europe has definitely been the leading region in terms of the pressure on the ESG side of things. So I think, that's been the lead, if you like. I guess our business footprint is more towards, Europe, Asia, and LATAM. And I guess, relative to, Europe is way ahead, I would say, but it's increasingly becoming, more of an interest in Asia as well, I think. And to a certain extent in LATAM, I think people are understanding that actually potentially ESG factors are going to have an impact on their investments, either because, people will start to exclude certain sectors or companies or whatever, or because they actually want to have a more sustainable investment objective. I think the other sort of trend that we're seeing is more around which types of institutions are more focused on this. Clearly, government sectors, they've been sort of at the forefront of some of those allocations towards more sustainable investments. And I think we're seeing it increasingly in sort of, with insurance companies and with other types of investors who are perhaps, starting to think about how, from a corporate responsibility perspective, actually they need to have their investments parked in the right place. Yeah. Internally, I guess we're also seeing it from our wealth management division. It's becoming increasingly interesting to some of our, private and high net worth investors as well. But I would say in terms of the order, it's kind of Europe followed by Asia, and then it's probably more institutional investors. And I think the thematic is growing with private investors as well.
Yeah, thank you, Michael. Mikael, are you experiencing the same demand specifically? Are you getting your highest demand from the pension funds, sovereign wealth funds, endowments, retail?
I mean, it's here in the Nordics. We're sort of like, which is our roots are here. We obviously sell our products these days, sort of around the globe. But sort of like in the Nordics, it started many years ago with the sort of the pension funds and sort of those kind of investors. But these days, I haven't seen a Nordic client mandate, institutional mandate that doesn't have a sort of large ESG for quite some time. So that is sort of across the board. That is sort of a very high priority, and we are starting to see that more and more as well. And I really think that this is a trend that has legs. It's a trend that's not going to go away. So I think urge investors, if they are sort of investor who sort of don't sort of think that they will be sort of sector isolated from that globally. I don't think they will be. That will come through, and that will have sort of effects on sort of on the disclosure, on how the companies sort of work, and sort of like the companies who are sort of good at this within that sector, within that region, whatever, they will attract more capital, because sort of the demand, at least from our clients to us to report on various issues, just sort of keeps growing, and that means that we will sort of ask from the companies, and then we're sort of so when that goes on and on, it will have an effect on everything. And as Mikael said, private individuals have sort of started asking this for quite some while. We have geographies that 2 years ago sort of didn't sort of really it wasn't sort of that interested maybe in these issues. Now it sort of comes in every sort of DD, every request. So I think it's a sort of a mega trend that will continue.
Thank you, Mikael. And I wanted to ask you, I mean, is it concretely in the credit space that clients demand this, or is it also extend to the sovereign space?
I mean, it's across the board. It's sort of but sort of like if it's fixed income, it's equity. It started to be private assets.
Yeah.
Obviously, sort of on the fixed. If you talk fixed income, it is easier. On a credit, it's more easier to do the sort of ESG. Sort of you can sort of look at CO2 levels. You can look at sort of you can look at sort of social aspects of how the bodies look like, and you can sort of look at sort of governance and all those kind of thing. Where sort of for government bond, it's a bit more difficult, right? To do those.
More subjective, right? Yeah.
Yeah, it's more sort of like. And it becomes more sort of like a sort of it's not an objective sort of analysis. It's more sort of your view of certain things that what you think on those. So it's but as I said, it's across the board and means that the demand for data is growing massively in that space.
I mean, definitely Nordic countries at the forefront of sustainability. And so it's really interesting to see that. And we've definitely seen a big focus, as you said, in equity. We've seen it in the corporate space, and the sovereign is sort of lagging behind. But it seems like it's gaining some traction. So it's great to get a view from you, right? Because it's a different approach altogether. And it seems to be very different threshold, right? Depending on the client base, that they might be more strict or not. And it becomes a little more subjective and harder to address than the corporate space. So definitely very interesting.
Yeah, I think on the government space, the sort of the demand is, at least from us, is sort of for us to do sort of the own analysis and come up to sort of to what do you like and what you don't like, and how have you sort of assessed these sort of various issues.
Yeah.
Whereas sort of in the credit space, you need to do your own work as well, but there you have sort of at least you have a more various amount of service providers with service you can buy on top of your own analysis to combine those two.
Yeah, I also wanted to ask you, it used to be exclusions, right? That was sort of the focus. Now we're seeing sort of a combination between exclusions and best in class. What's your approach?
Our approach is sort of that we have a few sectors that are inclusion, but then we want to sort of engage with the companies. So we want to see that Evli, for example, just sort of made a sort of statement that by 2050 we will be CO2 neutral, and by 2030 we will halve our investments. So then we want to sort of start the discussion with the companies that what's their approach to achieving those targets. How will they sort of what technology are they bringing on? What type of sort of internal targets are they putting on, and how can we work with those two in order to achieve those targets? Yeah. As you are aware, sort of EU has put severe sort of pressure on companies to do that, but sort of we are sort of seeing that expanding across to other regions as well, where sort of that companies start to take those much more serious, disclosing various targets and those. I think exclusion alone is not that good approach, because what happens is that you easily sort of just withdraw the capital from those sectors that we need the capital in order to adapt.
Yeah, I want to ask you, Mikael, because you've been at the forefront, at least Nordic countries, and those are your main client base. How has the engagement changed since this whole pressure that we've sort of seen since last year, and especially this year? Has it changed the attitude of companies you engage with? And how willing?
Definitely sort of on a longer time horizon. I can't sort of really say that during the last year, because sort of I would say it changed earlier than that. Okay. But but definitely sort of it has changed that companies have generally speaking have a sort of a disclosed policy. They're very willing to discuss those. What has changed during the last year, maybe, and that's a true change, is that before the companies had them, but you had to ask. These days, in investor presentations, at least in Europe, they'll tell them in the investor presentations already before you actually ask in those.
Yeah.
So that's a sort of true change.
Yeah.
That has come really during the last year.
Yeah, I can say for myself that I look at fixed income funds that they used to be one slide, now they're at least 4 on sustainability. So I've definitely noticed that as well. Thank you so much, Mikael. I think it's really insightful. Thank you for that. And Michael, I wanted to turn it over to you and specifically on how reliable ESG data is, right? I mean, there's MSCI, Sustainalytics, there are lots of companies out there. Do you feel, how reliable do you think this information is? How much do you have to rely on your own analysis? Do you use the data from different sources and do ratings yourself? Do you rely on external providers? Please enlighten us.
Sure, there's quite a lot of topic material there. I guess in terms of sort of the rating, let's call them the ratings agencies, because I think ultimately we'll probably go in that direction. But Sustainalytics, MSCI, I think there's still a lot to be done in terms of methodology and in terms of the overall ratings that they produce. They come up with very different conclusions and what they include and what they don't include and the materiality factors that they apply. So from that perspective, I think it is important to do your own work, because I think particularly when it comes to credit investment, it's not just about, I don't think about having an ethical rubber stamp on it, if you like. It's also about understanding what the impact of that potential issue might be, whether it's carbon tax and carbon exposure, whether it's social issues, labor relations. When you're talking about credit investment, you're really talking about downside risk management, as I said. And I think from an ESG perspective, clearly these issues are going to have a much bigger reputational impact. You go back to Volkswagen in the middle of the last decade, and you saw the impact that had on credit bonds. So I think for us, it's very important to have your own sort of materiality process. You can integrate the data from some of those different sources, and then really focus on, okay, what's the downside impact or what are the potential upside opportunities? Because actually, if disclosure is bad and it's improving, that might actually present an opportunity from a credit perspective, because suddenly, if that disclosure improves, then more investors are going to start to look at that individual credit. So for us, it's very important to think about it in terms of use the data, but think about the materiality in terms of the impact on your investment. I think the challenge really is integrating the ethical side of that, because everybody has a different view in terms of what's important from an ethical perspective, whether it's, the social dimension, whether it's the environmental dimension. I think that's where it's, it's quite challenging to sort of satisfy every single investor who's out there. So our view is very much, you have to be able to look at what's going to be material and then articulate your values to your investors in terms of the ESG factors. I think the challenges for us as managers is, and as you as a selector, is obviously you need some kind of benchmark to be able to compare, and that's different funds and different strategies. And I think that's what's really a challenge for end investors today is, well, which solution do I use and how much do I have to rely on actually talking to managers to understand the underlying process?
Yeah, there seems to be a wish to what you pointed before, right? The credit agencies, right? The rating agencies, instead of approaching it that way and not excluding anyone, but sort of finding opportunities of a potential upgrade, right? On a sustainable level rather than on a credit level, right? Along the same lines.
Yeah. I mean, I'll give you an example of, a call I was on this week with a company, a state-owned gas company from the Middle East. And the question came from an investor: MSCI don't include, one of your metrics, and this is, your carbon footprint, and this is causing you to be, underrated relative to your actual quality. The fact the ratings agency hadn't included a piece of data because they weren't releasing it on a regular basis was actually having an impact on investor appetite. So understanding these dynamics is kind of important. I think it is driving change.
Yeah, it's sort of what I was talking about with Mikael, right? Before that, I feel like definitely companies are noticing this pressure, and they really appreciate asset managers helping them out.
Yeah,
and the calls are probably more productive than perhaps they were in the past.
Yeah, definitely. They sort of they like the sort of interaction, the discussions, because sort of the questions the asset managers are asking them, they know that other people will be asking them soon as well.
Yeah.
So if they can sort of put that data in front of you, then they can sort of improve their attractiveness.
Absolutely. Thank you for that. It's certainly a fluid situation, and I'm sure a lot of changes lie ahead. I'd like to switch over to another important subject, and that is passive versus active. I'd like to start with you, Mikael. Do you think the current environment calls for an active or a passive approach? I'm pretty sure I know, but I'd like to hear from you.
I think sort of like this situation, the sort of where we see the most value, the sort of short-dated crossover. I think that's sort of something you definitely need to go active on. I think passive investors in fixed income is more sort of from an asset allocation, quick asset allocation. You go into some sectors for a short while, you go out for a short while. If you are sort of even slightly longer dated, or also be longer, more invested, I think active is the way to go, almost regardless of the sort of the environment, and because of that. The amount of sort of credit that are available, sort of the ETFs in credit space usually sort of focused on the largest issuer, and being active expands the opportunities greatly. So I think that's always going to be the case.
So definitely a combination. Yeah. Michael, what are your thoughts on passive versus active debate?
So, I mean, I think active management pays off in areas where you've got the underlying credit research and there's greater dispersion in the market, and I think that comes in EM and high yield to much greater extent. You have clearly you're dealing with finer margins on sort of high quality government investment grade bonds. So I think that's where ETFs probably work best. Certainly what I noticed through the crisis and what we've seen in previous crises is actually when you want the liquidity from those more illiquid sort of or specialist asset classes such as EMD or high yield, then you also find that the ETFs trade at very high discounts or premiums. So in those types of environment, actually, I think you're paying for the liquidity premium anyway. So I actually think if you're thinking about, I agree with Mikael. If you're looking from a long-term perspective to allocate to a core manager and you want core part of your portfolio, then I think active can generate you better returns in fixed income. And if you want to sort of quickly change your duration exposure or your credit quality, then for tactical reasons, then maybe ETFs are a good way to do that. But I think there's definitely a strong place for active management. And I think in an environment like we are today, where I think a lot of the beta is, there's not a lot of upside beta left, perhaps actually the active management can deliver the extra return you need to complement yield.
Thank you both for your candidness. All right, I'm conscious of time, and I want to ask you a final question. Well, I believe there's going to be less as a consensus across both of you. I have no doubt that there is a clear consensus across our panelists and the audience that Brazil will win the Copa de América. But who do you believe will win the Euro Cup? Mikael? Don't say... Please say Spain. You can say Spain.
I'm going to go for Italy. Sorry.
No, they've been doing fantastic. Absolutely. Michael, any thoughts?
My heart says England, my head says Belgium.
All very good teams. I think they're all strong contenders. I got to cheer for Spain, but I think they're clearly all good contenders. Thank you both. I believe it's now time for questions from the audience. So let me see what I can find here. Some questions. I have a very interesting one. What types of alternative assets or sources of yield that you guys are looking for? Private, real estate credit, venture debt? Who wants to take this one? Michael?
Yeah, I can take that. So I think private credits are very interesting, sort of like in this sort of low yielding environment. When looking to get into those areas, I think sort of it's important to see that what is the sort of the amount of managers who do this has sort of increased really rapidly. So the sort of, I think the first question I would sort of ask is, what is the source that you will source these sort of assets from? That sort of that how if you attract a lot of capital, how will you deploy it? So I think that's, but I think sort of private credit in this environment definitely looks interesting, but I would sort of ask sort of that how will you deploy that capital? I think there is a sort of risk that with so much money floating into this asset class compared to history, that yes, from now all the managers won't be able to invest that money.
Yeah. Thank you, Mikael. Michael, would you agree with Mikael?
I would actually probably disagree slightly. I think, when you're looking at those types of investments, what you're typically getting is a degree of liquidity premium, and with that liquidity premium being eaten up by by entrance into the market, then there is a bit of a danger there that I think actually you've got to very much take a long run view. It can't be a sort of a short-term investment plan. You have to think about it as complementing your the rest of your portfolio. I think the liquidity premiums that you're getting are probably a little bit rich, and so you need to take a long-term view on those sort of more niche, less public market orientated asset classes, if you like. So I would say that it's interesting to diversify, and I think from the perspective of looking for yield in this environment, diversification is quite important. And certainly when we're thinking about various types of risk, at least in the public market side of things, we're thinking about other instruments, hybrids, capital contingent callable bonds, convertibles, all of these types of instruments as ways of diversifying income and yield. I think this sits in that camp, but would I strongly sort of be like, this is the place to go? I think there's a danger actually you're going into a liquidity trap to a certain extent.
Yeah.
They are long-term investments, right? That sort of that you have to sort of, they are not the ones you need in a year in years from now. It's a sort of long-term money.
Yeah, but definitely interest has picked up considerably. I agree. All right. I don't think we have any more time for any questions. We're nearing the hour. So I'd like to take this opportunity to thank you both for sharing your thoughts on the fixed income markets today. And I'd also like to thank the audience for listening in. I hope you enjoy the rest of the conference. And let me now pass it over to Philippe for some final remarks. Philippe?
Ok, thank you, Vanessa, Mikael e Michael. Como vocês puderam perceber, tivemos um problema técnico com o sinal do Arif, da T. Rowe Price, um dos nossos palestrantes. Gostaríamos de nos desculpar pelo ocorrido. Lembrando que atualmente, em parceria com a T. Rowe Price, oferecemos aos nossos clientes 2 fundos aqui no Brasil. O fundo Global Allocation, um multimercado com foco em uma carteira global de ativos, e o US Smaller Companies, um fundo de small caps de empresas americanas. Muito obrigado pela presença de todos vocês e não percam amanhã, a partir das 10 horas, em nosso 4º dia de conferência, o tema China, a próxima grande classe de ativos. Muito obrigado, um abraço e até breve.